Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing show. I'm going to have to change that bumper, Guy, because 60 years experience is about 30 each. I'm way too young to have 30 years experience. You, of course, are fine.
I thought you were going to bump it to 63 years. And I'm Guy Allard, and we have got a great show for you today. Glad you're here to join us.
Lately, we've talked about required minimum distribution. The market has been overvalued. We don't want to, beat that dead horse, but it keeps getting, the Case-Shiller index. Robert Shiller won the Nobel Prize for economics. He uses an average of 10 years of earnings to give his price earnings. You were talking about before we started the show that it's amazing how many different PE ratios they run. And you're right. They try to find one that works for them. Like, okay, that's the one.
Well, that's the problem. If you're looking at a house to buy, or if you're looking at investments, people can verify anything with statistics, almost within reason, right? They just take a different time period before or after a crash, moving average, 3-day average, forward earnings, past. There's all sorts of ways, and trust me, if they're really just trying to sell you something, they find the right one that documents their case. I heard an interesting deal on the news the other day. We're talking about the different ways they refer to crashes.
Yep.
It used to be, what did they used to call them? Adjustments and corrections and softer words that we talked about. Now the new term is recalibrating. When will the market be recalibrated? And whether no one knows for sure, but I thought it was interesting because with all of the signs and the PE and everything, no one's denying that a crash correction or recalibration is due, right?
Right.
Everything is out of kilter, but optimism to me seems to be up, with Trump in there. And basically, I think getting rid of the regulations and allowing things, that's what he's been able to do so far. And now they're counting on tax reform and repatriating money and all of that to stimulate it. But the question that was asked is, when will this crash, recorrection, or recalibrating occur? And the answer was interesting. They said if they get tax reform through, which I think is a big if, right? Because you see all the infighting, and we certainly know there's nothing going to happen across the aisle. It's going to have to be one party or the other. But they said if we get the tax reform through, it should push us off to second or third quarter of next year. Now, no one knows.
Right.
But the point was, they didn't say a year or two or, woohoo, we're ready for, another 10-year run. They said if we get this through, it should push it off to the second or third quarter of next year. Now, I don't know if you subscribe to that or not, but it's interesting they're talking in those terms.
It's amazing trying to listen to analysts, because some analysts are always bearish, some are always bullish. Some of them have been bearish for 7 years now, and they've been wrong for 7 years.
Sooner or later, they're right.
Sooner or later, right. But the ones that only concern me now is you're seeing all of the traditionally bullish analysts are coming out saying,
yes, that's right.
You got a Case-Shiller P of 31 when historical's 14 or whatever, 15. There's something that's got to happen.
So what do you do when you're faced with these circumstances? The market's jamming. It's been just cruising for 8 or 9 years. What do you do?
You got to be prepared.
That's right.
We manage stocks. We both own stocks. We know how much it's made. It's done great.
That's right.
I look at my account and I'm like, ooh, look at that. But you still have to be prepared. You've got to be ready no matter what happens. Because if you have a retirement plan, or even if you're 50 and not going to retire for 20 years, losing half your money takes a long time to get it back.
That's right.
And they're talking about, there's only one I've read, one analyst, an economist, that thinks there's not going to be even a correction.
What does he base that on?
They're basing it on a whole bunch of things, that the regulations are going down, the forward earnings they expect,
all right,
and this kind of stuff. But even them, they said you're going to have really bad returns for 10 years. Because without a correction, with the trajectory it's on, they said the most you're going to make out of equities is about 4% a year. The most you're going to make out of fixed income is about 2% a year. So I'm not risking all my money for 2 to 4%. You know what I mean? I'm going to put it more safe and go ahead and get 4, 5, whatever.
They're talking about repatriating the money and what it's going to do for the economy. And everyone's has an opinion. It seems to me the most logical thing will happen. At some point, we'll get this correction, recalibration, or adjustment. But then what usually happens right after that? Usually it spikes back up and we could continue to get growth. Now, I would vote for that. I've also heard by very sharp people that it's once this happens, it'll be slow growth for a long period of time. But that doesn't give any credit or acknowledgement to what's trying to be done, to the rules and to the regulations and the things that have been eased. But to go back and answer the question, what do you do? Its market's been rocking, it's still rocking. The short answer is, and you'll hear Victor and I talk about this probably until the correction happens, but you've got to take some money off the table and protect it. That's the short answer. The long answer, which we've always, if you want to justify it and you need a foundation, if you've got your accounts allocated correctly, we talk about the rule of 100. You take your age and you subtract it from 100, meaning if you're 60, you subtract it from 100. 40 is the most that you should have at risk and be in the market. So let's use those numbers. You're 60, you've got 40% in the market, you've got 60% conservative. It's going to generate income for you in retirement. However you've elected to do that, your 40% over the last 8 years is probably now 50, 60, maybe 65 or 70% of your portfolio. It needs to be rebalanced. No matter how good the market's doing, and we've talked about it, it's counterintuitive to take something out of a winner and rebalance it into something that's not doing as well. But how about you take some of that off the table, knock that back down to 40%, take some of that out and put it on your safe side. It's a win-win situation. What's the worst that happens? You came out of the market a little bit early and you've got more tucked away, protected safely, and you still got your 40% growing for you in the market and exposed for when the correction comes.
Human psychology is very difficult for people to, the emotions. They don't do it. You know, everybody didn't start out with 90% of their portfolio in tech stocks in the 90s.
No, but
they started out with like 10%.
That's right.
And what they're having is this one makes 40% in a year and this other one made 4%. We'll put more over there. And they did that for a while. And then that one just kept growing. So now they end up with an 80, 90% portfolio that drops 80% the NASDAQ did. Right? That's what you end up doing. So what we've had now is if one asset class outrules all others for a long period of time, even if you don't reallocate, which some people don't, the growth on that one side makes your imbalanced portfolio because, you know, it makes sense. The rule of 100 when you go 100 minus your age, easiest thing is just take your age. That's how much you should have safe.
That's right.
It's a real thing. Just take your age.
That's right.
In other words, think about it. 80-year-old, should they have 80% safe? Yeah, probably. Obviously,
maybe 100, but we'll go with 80.
You can go a little here or on either side of that.
That's right.
Because that's a rule of thumb. But the rule of thumb has been there for a long, long time because it holds true every single time. But it never holds true in the middle of a bull run. In the middle of a bull run, if you had 100% stocks this whole time, you'd have done a lot better, right?
Absolutely.
I should have never had any of that.
And you feel silly if you didn't.
Yeah, that's right. I'm the dumbest thing in the world is putting some over there. And you can always look back. But I'm telling you, if you did it every single time, you rebalanced every year, you never had those huge down markets. You never lost half your money ever.
That's right.
Not one time have you ever gone down 40%, 30%. Never.
Right. Simple rule.
That's right. You have never lost. Because remember, your equity side lost 50 twice. But if you only had 50% there, it means you lost 25. If you'd have always rebalanced,
absolutely,
the worst you could have ever done for a 50-year-old is lose 25%, which you can make back because you might be making 3 to 5% on your fixed income stuff, you know.
We started off talking in the show about statistics. You can collect those to almost validate any case within reason. This is another area where you got to be careful. It was the College of Financial Planning that came up with this rule. That's the rule. Now, I know things change. It's kind of like the Constitution. Is it evolving or does it stay the same? There's different schools of thought. Stock people who do stocks and been put in a mind vice, that's what they know, that's what they do, that's what they love, that's how they feed their family, so nothing ill will meant towards them. But I've heard a number of times that rule changed. They call it the rule of 120. you take your age and you subtract it from 120. Well, what does that do for a 60-year-old? It's 60-60 now instead of 60-40. So it allows you more exposure in the market. So be careful. The rule hasn't changed, but depending who you talk to, they may tell you it's
You
the
know
rule
who changed those
120.
rules? The Rule 100 has been around forever.
Right.
It's mutual fund companies.
Yeah.
They've changed the rules. Now you can go to 120. And I really think they're rules of thumb, so you can
There's
get a
some
little
fudge
allocation.
Absolutely.
Maybe
sure.
10% on either side.
And your risk tolerance has
Right.
a lot to do with it, right?
And
How much money you have.
Because what they're doing, traditionally, an older person is more conservative than a younger person, but that doesn't fit everybody either. Sometimes you'll find a really aggressive older person and a really conservative younger person. Millennials are a good example. They are one of the most conservative groups ever that's come up. They're not a huge stock market people as much as baby boomers, Generation Xers, and things like that.
By rule, they don't have that much saved up
Well,
yet.
think about it. You're a millennial. You've never seen some great bull run. You've seen the last few years, but you've never seen it. You never saw like the 90s and all that kind of stuff.
Are you talking about still in the basement at mom's, that type of millennial? Or?
Well, since what, 70% of all millennials are still living with their parents. Or something like that.
just
50
saying.
to 70.
I don't know. It's a
I think
crazy
that's getting us
number.
to like 30 years old, too.
That's right.
So that's a little strong. I give it that. I can't say much because I raised a millennial, right?
When I grew up, the girls were allowed to stay at home till about 25 or so. The guys, as soon as you finished school, you were out. And if you really look at it, at 18 when you were in school, you were kind of out.
It was 2.5 weeks after my 18th birthday I was out.
Or you were working paying rent.
That's right. There's no way to let me stay a day longer.
That's right.
But it's it's a different world now. We coddle the kids. We put the participation trophies. Everybody gets a trophy. There's no winners and losers here. We're just having fun.
Boy, that just takes away all the competitiveness. Hey, you were mentioning in the beginning of the show talking about RMDs. I've got a thought on those, but it may be completely different than what you had in mind. What were you going to cover on RMDs?
Oh, I just said we talked about it in the last few shows or whatever. It's getting that time of year. Okay, that's why I wasn't going to discuss it too detailed, but remember, it's April 1st, a year after you turn 70 and a half, is when you have to take your required minimum distribution. Some companies call it MRD, minimum required distribution. The IRS calls it RMD.
And what's the penalty if you don't take it?
It's 50%.
50%.
So what happens is there's a little confusion on the first time.
Yep.
What happens is, yes, you can wait till April of next year if you turn 70 and a half this year. But you're going to have to take 2 withdrawals for 2018. So usually it's better off just to go ahead and take one at the end of this year, even though you have a few months early, so you wouldn't have to take 2 next year. Because what happens is when you take 2 in a given year, it messes up your retirement planning some, but it also makes you pay a lot more taxes because you got more income in that given year than you normally would. And hopefully it can knock you up into another tax bracket. So you got to be careful with RMD. So all of you that have IRAs and you turn 70 and a half this year, I suggest go ahead and take in that RMD this year by December 31st.
And here's my little nugget on RMDs for the show. Without going into all the details of Roth IRAs, the pluses and the minuses, which we've done a lot of times. A lot of people love them because it's just tax-free money at that point. No one wants to pay their Uncle Sam taxes, and unless you're in the highest bracket, it may be a detriment. When you have a Roth IRA, you're no longer subject to RMDs. However, at your death, if it's a non-spousal inherited IRA, even a Roth IRA now becomes subject to RMD. So I'll repeat that. Not for your wife or not for your spouse, if it's the husband or the wife that passes first, but for a non-spousal, easy for me to say.
Your kids get the Roth. How about that?
Yeah. For a or a friend, whomever, a non-spousal Roth IRA gets inherited, they are now subject to RMDs immediately.
So there's a limit on the tax-free part of the.
That's correct.
of a Roth, because they're going to eventually, somebody's got to take the money out of there. You can't just keep it rolling.
If you have inherited a Roth IRA and it wasn't from your spouse, what was the penalty again?
50%.
50%. So make sure that you get the numbers, get the charts, and you're taking your withdrawals.
Fortunately,
from your Roth.
very few heirs pay that penalty, the 50%. Not because
I know where you're going.
99% of all inheritance is spent within 18 months.
That's right.
What they do basically is They're not paying anything. They're just taking the money. Well, it's okay. You got my kid's buying a house.
Yep.
Putting a down payment on a house, buying furniture, whatever. Getting out of credit card debt. But that's what happens 99% of the time. So you don't have to worry about it mostly, but just they got to know.
How many clients have you seen, Victor, or potential clients? And I'll just, an arbitrary number, not speaking of any particular case, but you have somebody come in to see you. They've been referred to us. They've heard the show, whatever, and they've inherited $1 million. It may be some Roth, may not, maybe a combination thereof. And usually they sit down with us within 30 days, maybe 6 weeks, and that $1 million is down to about 350 or 400,000.
It happens
already
every few weeks.
You don't have to chop the tree down to harvest the fruit. You got to feed the tree, you got to water the tree, and just harvest the fruit. But when people inherit money, psychology of investing, it's just not human nature to do that.
It's almost like a shopping spree money.
Right.
You didn't,
like a lottery ticket.
That's right.
Woo-hoo.
I got it. I have a client that had $3 million, a house given to him, paid for, really nice house.
Right.
Cars, everything else. And we actually put some away. Said, I know myself. I'll put this away. They still went and got it.
Exactly. I hear you.
Spent all of it within 3 or 4 years.
Is it all gone?
Yeah. Now they have a child. And it's all gone.
Oh, I know who it is.
Yeah. Don't tell me.
I'm not going to say anything. But I just in life, I remember who it was.
But it's just, it happens. All these stretch IRAs, everybody goes, oh, I got this stretched out. Stretch IRAs are worthless unless everybody down your downline is bought into the fact that they're going to stretch this thing forever. Because what they'll do is we're going to take your 100,000 IRA, we're going to make it $400 million over 6 generations. It never gets past the second one.
That's right. What Victor's saying, and just to be a little bit clearer in more detail, if you're planning on a stretch IRA for your children and you want them to stretch it and grow it, the sad thing is it's not up to us. When we're gone, and it's up to the heirs. They get to decide. They've got 3 choices, basically. 1, they can take a lump sum now. Probably most of them do. 2, they can take payments over 5 years. Very few do that. And 3, they can stretch it. Which one do you think they take? Yeah. Number 1.
Stretching it is the smallest amount, by the way. If you don't,
yeah,
that's the very smallest amount you can.
Immediate amount.
Yeah. If they're 40 years old, it might be 2% a year. Yeah. So they got this $1 million inheritance.
Yeah.
And they're going to spend $20,000 a year throughout their lifetime. It ain't happening.
No.
Even though that's the smartest thing to do, right? It's just not happening. So a lot of these plans, I used to see all these seminars. We're going to turn your IRA into this, and it's a bunch of BS. It's almost like it's just not accurate.
The problem is, again, it's not up to us. It's up to the people inheriting the money. They have to make the decision.
Right.
Unless you go into a trust, and that has whole other repercussions.
Yeah, there's a lot of
unintended consequences and things that go with that as well.
I see people all the time. Trust cures everything. I go, what?
Yeah.
What are you talking about?
Nothing cures everything, does it?
No. They say, well, I don't pay estate tax. It's impossible not to pay estate tax. You've moved stuff around, you're going to pay it one way or the other. Now, if you don't own it, like you'll have different shell companies, you own this and this controls it. You could do that. Really rich people do that kind of stuff. They said that only the real rich never pay estate tax. They got 5,000 trusts back in, this trust owns 42 trusts. Those 42 trusts own this. Holy moly.
But with that, you have to have a lot of money for you able to access what you want to access out of those, because you still have issues.
Right. You got to make, if you make any money in a trust over $16,000 a year, you're in the 40% tax bracket.
That's right. That'd be real quick.
Yeah. So you don't ever put income generators in there, even they do. I see it every day. You don't do that kind of stuff. But let me go over this one thing. It's I keep hearing these commercials. We've talked a little bit about it before. Bank on yourself commercials.
Sure.
You'll hear the.
Are they the ones that tell you not to invest in an IRA?
Oh yeah, absolutely.
If you're investing in an IRA, stop. Yeah.
If you're investing, it'll beat the pants off a 401k IRA.
Like that's the investment.
That's right. Yeah. Remember, a 401k IRA is not an investment. It is just a holding vehicle. Sorry. Guy just got a cramp and then almost died laughing.
Jumped out of his seat.
It's what happens when you get middle age. It just jumps on you.
Oh Lord.
But and what they're using, it's what's the other one? It's Banking Yourself, and there's another one.
That's what I'm familiar with.
Oh.
In life settlements and things. But.
Yeah, but it's an index universal life policy is what it is, 90% of the time. And what they're talking about doing, you get tax-free income, you get great growth, you're borrowing from the cash value.
And if you're young and healthy and you've got lump sums to put in, it's a great deal.
Yeah, it's got certain aspects. The only problem with a lot of those, they just sell the one that pays them the most.
Well, or I tell you what they also do. If you're looking at one of these, make sure the numbers they're running their illustration off are realistic. Sometimes they run them off 7 or 8%. The market hasn't done that in 17 years.
Yeah.
You need a realistic expectation if you're going to do this.
Right. They'll put bad illustrations together, but let's say a person is 30, they're really well off, and they're going to retire at 45. Well, that is a possibility for that person. Let's say you're doing a buy-sell agreement for a company.
Right.
In other words, you don't want your partner's wife to take over because he just married, a mail-order bride from Russia. Whatever, That's the kind of stuff you can have a buy-sell agreement. An index universal life is decent for it. But honestly, in those kind of things, usually it's a GUL, guaranteed universal life, so you put less money in it. You're going to overfund one if you want some income out of it. You'll overfund it on purpose.
I did hear on the news the other day they're thinking of making pole dancing a Olympic sport.
I did see that. Are you gonna join?
Thinking of all of you, the young wives.
I just want to see the training that you're training throughout the year. I got to see this. It's ridiculous. So you throw off my deal. But index universal life is not the end all be all of investment. They say don't do the stock market. It's a casino. This is the best one. Bank on yourself. Here's what they say. This is what billionaires have been doing forever, that kind of stuff. But there is a little bit of truth, but not a lot.
But like everything else, like fixed annuities, when we talk about them for creating income and taking care of your hard expenses, the market for hedging inflation, these index universal life policies, again, are great if you're young, if you're healthy. You can create great, and I mean great, tax-free income borrowing back from the policy. You start when you're 40, and if you could put $50,000 a year in for 5 years, maybe $250 in, by the time you're 60 or 65, you've got 6 figures of tax-free income. But it works because of the age and the health. For that person, it's a round peg and a round hole. Problem is, that's all they do. They're usually not licensed. They don't have a whole lot of accountability. Certainly not much compliance, and they're constantly trying to put a square peg in a round hole because everything they do. Forget the IRA. Get out of your IRA. Do this.
First sign of a crook, either an ignorant ass or a crook.
Right.
One or the other. They can't be other, is when they tell you not to do a 401k, not to do an IRA. That is the first sign that you have now talking or listening to a crook. Like I said, or they're ignorant, one or the other. But I hear it all the time. Oh, my gosh, it's not. What's the real estate guys?
Or if they tell you not to do stocks, or if they tell you not to do annuities, or if they tell you not to do something that's a good bona fide investment, there's an agenda.
That's right. If they start calling the stock market a casino and start calling it, what do they call annuities? What do they call? I don't even know.
Too many fees or something.
They're
restrictive.
They're not legitimate. You can't. But it's easy to spot someone that tells you not to do a retirement account. Not to do a retirement account that's tax deductible. Hopefully, it'll still be tax deductible in a few years. They keep talking about not, putting the 401ks on the chopping block and all that.
I know.
But anybody that tells you that is not looking out for your interest. They're just trying to sell you, and they know a vast majority of people's savings nowadays didn't used to be like this. But with 401ks and all that are in some kind of retirement account. So they tell you to sell it out, buy some real estate, they're, like I said, they're a crook or they're ignorant. And they'll tell you the million different. Remember, these are professional salesmen, professionals. And so they're going to have a good excuse. But I'm telling you, mathematically, it cannot work. It never will work. You're getting. I listened to a radio show, and they were talking about the lady had $1 million. He said, get out of that 401k thing you got there, and you're going to cash it. It's not your money anyway. It's the government owns half of it anyway.
That's right.
I go, you ain't going to pay tax on half of it unless you take a lump sum.
That's right.
I go, that's what they'll just keep going on and on and on in some ridiculous tangent. They told another lady quit her job because she was under 59 and a half and couldn't get hold of the 401k.
So that she could access it.
That's right.
Oh, yeah.
Oh, we'll get you that return back, what you lose in taxes in probably a year, a few months. They're just crooks. And you're wondering, why can people say that kind of stuff? Because it's a private investment. Yeah. It's like the Old West. There are no rules. My great-grandfather got shot in a poker game in Wolf City, Texas. There wasn't any rules back then.
Shot dead or just shot?
Oh, no, shot dead.
Oh, wow.
He accused the poker player gunslinger that came in town. He was a farmer.
What year are we talking?
Gosh, 1900 maybe.
Wow.
I don't know.
That's a good
Well,
story.
he walked in there with a shotgun to get his money back from the gunslinger. Didn't work out too well for him.
No.
So there's no rules in private investments. They don't have 4 different regulatory bodies covering them like we do. If you've ever dealt with just one government agency, just one, you know what a pain in the ass it is, how terrible it is. Well, try dealing with 4 every day. That's what we do. We can't say crazy stuff.
What do they say the 10 worst words are? Ronald Reagan's statement? Oh. I'm with the government. I'm here to help you.
Oh, yeah.
Speaking
I
of
thought you were saying the 10
agencies.
cuss words you can't say on the radio.
No,
you're not going to say them, are you?
No. The 10 words that you never want to hear. I'm with the government. I'm here to help.
But that's what you have to deal with. Stay away from private investments. There's nothing wrong with stocks, bonds, annuities, CDs, money markets. It just depends on your particular situation and what best fits you.
And be careful again, just to repeat it for clarity's sake. If anyone tells you stocks are bad, the insurance IULs are bad because they're good for certain situations, or annuities are bad. If anyone tells you one particular item is bad and a blanket statement, something's going on. There's an agenda.
Right. Yeah, it's ridiculous. And what they'll do is they'll take a little bit of truth. Like they'll take the worst one in an area. They're very good at like using annuities. They'll take a variable annuity with a 5% of your fee. Well, of course that's terrible.
Yeah.
But they're intimating that they're all the same.
We started out talking about statistics. You could do that with the mutual fund. You could do that with insurance. You can do it with anything.
Right. Somebody told me one time that people complain about it. There's less complaints on the fixed annuity side by like 100 times than the stock side. And I love stocks. There's nothing wrong with the stock market. But trust me, when somebody loses money, they're more apt to be mad than if they got into an annuity with a penalty or whatever. It's just the way people are. You know, remember our philosophy here. Our philosophy has always, will always be, I guess, for the last 30 years that we've been doing this, is pay your hard expenses. Have a consistent, guaranteed check coming in every month that pays the expenses. Then you use the stock market to cover in future inflation. Remember, you got to have a reserve account. It can't be 3 months worth of your money in cash.
No, you need more.
It can't be the same for a 30-year-old as a 60-year-old. You need 1 to 2 years worth of emergency cash. I know it's not paying anything.
And I know it's hard when you're there. You can't see the forest for the trees and that sort of thing. But we also talk over and over about the psychology of investing. If you're in the stock market and it's correcting or recalibrating or tanking, you're upset, you're mad, you wish you would have more annuities. If you're in fixed annuities and you got the consistent protected growth in the stock market like it is doing right now, you're doing 15% a year. You wish you had more in the stock market, but don't get derailed. Know what the allocation that is right for your age, for your risk tolerance. Know what your income is, taking care of the hard expenses, and follow the plan. The plan will work for you.
Just think about it. If you could forget stocks, bonds, annuities, anything. If you could take 10, 20, 30% of your assets and guarantee for the rest of your life you will never go broke, even with inflation, would you do it? Wouldn't you give that same advice to a lottery winner? All right, you got this $50 million. Let's take $10 million off the table. Let's make sure you're guaranteed for life. You can't run out.
Absolutely.
And that's going to pay all your bills. You can even get that $10 million house that'll still pay the bills. And then you can go crazy with the $40 million. But people don't do it. It makes every bit of sense every time. Take a little off, guarantee you won't go broke. Because sometimes you've already won the race. Why are you still running?
Yeah, absolutely.
You right now can guarantee your lifestyle. Don't stop there. Hey, don't hesitate to call us. If you have any financial questions, you'd like to take advantage of our no-cost, no-obligation retirement plans, Social Security Optimizer, our number is 972-715-2424. Again, 972-715-2424, or you can go to ilovemyretirement.com. I'm Victor McClure. For Guy Allard, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.